All right. It was another sell-off for the market. We had a nice recovery yesterday. It looked like, okay, maybe with the S&P 500 wanting to hold those lows, even the NASDAQ 100 managing to hold the October lows, that we were finally seeing a bottom. We saw a huge sell-off. S&P 500 recovered 200 plus points off of the lows of the day yesterday. So what are we expecting today? Should we have got that follow through? Well, I'll say just from experience purposes, the second day on what looks like to be a possible bottom or short-term bottom in the market is usually one of the most difficult days to get much out of the market. That second day, the day after the reversal, very difficult to get follow through. Usually that follow through comes on the third or fourth day by what I've seen over the past 20 plus years of trading. So wouldn't completely lose hope in this market just because it wasn't able to give you that follow through today and it finished lower. Now, as we're doing this, Microsoft reported earnings, and the earnings actually were good. They weren't bad earnings, but we're in a little bit of a different market now where the valuations, even if you're beating earnings, the valuations are getting knocked down. It's almost by default. I mean, we saw what happened with Netflix and Grant. They had horrific earnings, but now Microsoft with good earnings reports, and I'll just run it down with it. The revenue came in at $2.48 a share versus $2.32 of expectations. The earnings, $51.7 billion versus expectations of $50.8. So it was a beat on the major numbers. Then you also had, some of your subcategories like LinkedIn growing. You also had the Xbox services growing in profitability. So you would think that it would actually go higher, but it didn't. Instead, it's selling off. And I'll pull up the chart here for you guys. On MSFT, Microsoft, this is how we closed. Now, when I pull up the 1 minute chart, this is how the earnings are playing out. You see big sell-off. So it closed down 2.6% extra or after hours. It's trading 7.5% lower now. So a big sell of the news event, $2.5 trillion company is going to weigh heavily on the NASDAQ 100 going into tomorrow, and also with the S&P 500. It won't have as much of effect on the Russell 2000 because that's all your small caps. But this is significant because we're seeing a trend now with the earnings, and we still have Google coming up and Facebook, Amazon, Apple, and Tesla's tomorrow. Apple, I think, is the 27th. So we need to start looking at whether or not every one of these FANG stocks, or the majority of them, are going to get knocked down. I think the real telltale sign is going to be Apple because it has been able to hold up really well despite all the selling. It hasn't shown near the weakness that the broader markets has. And if it starts to show that weakness, along with Microsoft and Google, your biggest companies, I think that the NASDAQ 100 is going to go down a lot further than anybody would have expected. So today, we actually didn't see every sector trading lower. You saw a lot of strength in energy. Oil was up 2.2%. But when you look at my chart here, what do you see? You see up here in the right-hand corner, oil was the leading sector, up 3.4%. So pulling up the ETF on oil, or actually we'll just do the entire sector. That's a big candle right there. And so we had the huge reversal, and we actually got the follow through today on the energy sector. So big time. Also, make sure to put in your comments down in whether you're watching on YouTube, Twitter, or Facebook. Put your comments out there, and I'll go ahead and get to every one of your charts here before we wrap up the day. But oil is a big one. You also had financials. Now, financials are rallying ahead of the FOMC statement tomorrow. That's going to come out, creates a lot of volatility. I'm not a huge fan of trading financials ahead of the FOMC statement just because even if the markets rally, it could be a negative to the financial sector, and so they'll be a laggard. And I'm not a huge fan of that. So I kind of avoid the financials going into the FOMC statement because you just never know how the market's going to react. And tomorrow's a big mystery in regards to the FOMC statement. We know that he's wanting to taper and that he's looking at raising interest rates by 0.5%. But is he going to say something to make the market feel a little bit better in the short term? Or is he just going to go completely hawkish? That's the big mystery to it. And how hawkish he comes across tomorrow is going to weigh heavily on the financials and the overall market. So financials are doing good. I mean, I wouldn't say that's necessarily a massive follow through, but it's better than what any of the other sectors minus energy was getting today. But energy was the big one. If energy hadn't rallied, you would have seen a much bigger downside to the market. So one of the sectors that I would probably avoid for now is at least is tech. You're seeing the weakness in Microsoft. You saw it in Netflix last week from earnings, and you got 5 major companies coming up in the next week reporting earnings that you really, if you're starting to see the signs with Microsoft and Netflix, you don't really want to be blindly long on tech stocks right now, because regardless of what tech stock you're in, it's likely to get, hammered just by guilty from association. So yes, Swipe 650 just posted that Powell has his work cut out for him, and he certainly does. I mean, this is going to be one of those things, especially with the presser. He's going to get hammered with a lot of questions at 2:30 p.m. Eastern tomorrow. He's going to get hammered, and he's going to have to kind of tippy-toe, try to assuage the market of its fears that it's not as bad as it looks. You also have, too, the fact that President Biden's kind of given the FOMC and the Federal Reserve the green light to raise these rates aggressively and to knock down this inflation. It's very clear that Biden doesn't care about the market as much as he does about inflation. And that's not me trying to get political here. It's just based off of Biden's press conference last week. He's given the green light to the Fed to, hey, get this inflation under control. And that's one of the mandates of the Fed is to, get full employment and fight inflation. And you fight inflation by raising rates. So how aggressive is he going to be? How much willpower does he have to raise those rates, put the real estate market at risk, because higher interest rates makes the mortgage costs a whole lot higher? And if that's the case, what are we looking at for the will of the Fed to be able to keep raising these rates until inflation gets put under control? So I think as long as he doesn't get pressure from the White House, I think he's going to be pretty aggressive with it. And I don't think the market's completely ruled out the fact that he may even do a double rate hike on the next FOMC statement. So not this one tomorrow, but the one in March, that possibly to just really get a handle on inflation, he does a 50 basis point rate hike. So keep your eye out for that. Now, we talked about technology. I also want to look here at SPY, because we haven't discussed that at all, and that's very important. But check this out here. What do you see is these lows, these October lows have been very critical. We broke below them yesterday on huge volume, but we saw this massive rally to recapture it into the close. That's a good look right there. And today, despite the fact that it was down another 1.2% and it continues to drift lower, and after hours almost down 2% here, you're still seeing these October lows holding up. So that would be one of the clues going forward. Okay, are we going to be able to hold these October lows? And if so, that's good for a short-term market bounce. But I wouldn't expect this to be a bounce that goes right back up to all-time highs. I don't think you're going to see all-time highs for a while. Instead, I would look for it to be a dead cat bounce that becomes a short opportunity to ride the market back lower, to reload those short positions. I don't think it's a bad thing to try to tinker in some non-tech stock plays right now. I actually did one today, but it's on a tight leash. If it breaks below its lows from yesterday, I'm out of it. Manuel writes, since these are volatile times, what percentage of cash would you hold? So much of that goes back to the individual person, right? I mean, a lot of people can handle a lot more volatility than I can. So what might be appropriate for me may not be appropriate for everybody else. Right now, I'm primarily about 90+% cash, because I don't want to put any money to work, but I don't usually get like 100% short on the market. Usually it's more like 30 to 40% short on the market and the rest cash. To the long side, I'm willing to go up to 100%. Don't mind it at all. But right now, it's not the market to be getting super long. I think you can try to play with a bounce off of these October lows and see if it holds. But if it doesn't, you need to be able to exit rather quickly. So I'm not putting a lot of money to use right now until we get much more of a significant bottom in this market. Also asking what is the resistance on Amazon and Tesla? Well, in Amazon, you got a whole lot of resistance right here. Okay, this resistance ended up breaking. Let me just go ahead. I already got it pre-drawn. There you go. This resistance broke. You also have another layer of resistance, but it's nowhere close to testing it here at around 31.25. But for now, I would say about 28.91 is your resistance. If it gets a good, decent bounce, watch for that to give it a little bit of problem for the bulls to recapture. On the front with Tesla, 1,200 or just below 1,200 is going to be an issue. You got a little bit of a bull flag here going. It bounced off of this rising trend line. So all good, but I don't necessarily want to be buying Tesla right now until we get a better feel for how the earnings are going to play out tomorrow. I don't want to play Tesla ahead of earnings. We just saw what happened with Netflix. That's not something. I'm not saying that Tesla's going to have a bad quarter or anything. They may have a very good quarter, but like what we're seeing with Microsoft, it can get knocked down just because we're in a bear market or what seems to be an extended bear market being played out. So on that same note, being asked, what do I think Tesla will do with earnings tomorrow? And since they had record level deliveries last month, yeah, I'm sure it's going to have good earnings. But again, like what we just saw with Microsoft, it's struggling. It's down 7.5% after hours trading. That's not a good sign for pretty much any of the FANG stocks. And you know, Tesla has a 300 PE ratio. So if it has a 300, I just lost my pen. But if it has a 300 PE ratio, and the market's trying to knock down a lot of these high valuation stocks, there's a good chance that Tesla may see a sell the news. I mean, we got the big ripper when we found out that it had incredible deliveries. That's already getting cooked into the stock. So I would not be mortgaging the farm on Tesla tomorrow. As always, from a swing trading standpoint, I don't hold through earnings at all. I never do. So I'm not a believer in holding a stock through earnings. I think it's very high risk. And in this market, it's even more high risk. Relating to inflation, it is interesting that wage growth has dramatically increased, which seems to largely offset the overall inflation numbers the Fed has been instructed to combat. Boy, that was a mouthful there. Okay, relating to inflation, it is interesting that wage growth has dramatically increased, which seems to largely offset it. Okay, yeah. So, no, I agree with Daniel. I mean, a lot of people have gotten, raises, on their wages or on their hourly wages, but they're being offset. If you didn't get a 7% wage this past year, you lost money. Shabir, where do you start DCAing into Amazon and Microsoft for the long term? Don't have any shares. So with Amazon, I mean, this stock has been one of the most boring stocks just until recently. I mean, when it finally started to break down, it was trading in a sideways price range for the better part of a year and a half. Finally, it's breaking down. Where would I probably start looking to get long at? I mean, this is an interesting price level right here. If I'm just drawing it out, I'm looking for support levels. Where do we try to bounce at? This is a long-term support level going back to 2018, again in 2020. It hasn't tested it since then. So if it comes back down to this 23.35, 23.40 level, that could be a good place to possibly buy into the stock. I'm not saying for sure that it'll hold, because in these bear markets, major support levels will get torn down. Now, take a look at Amazon here from an even longer term perspective. You have a trend line that goes back to 2016. Let me move myself off of this picture so you can see it. 2016, right here. So we've seen multiple tests of it, and the COVID lows came back and tested it as well. Let me go ahead and get the comment off and put myself back down here. COVID lows tested this rising trend line, but we haven't tested it since. I think there's also a possibility that if we break this support level, that we may be seeing like a 21.28 level. So those are my two levels there to watch, about 23.40 and then about 21.28, 28.130 going forward. Two support levels. Now with Microsoft, one of the things I would tell you about Microsoft, let's go ahead and look at a weekly picture of Microsoft. Incredible run off of the 2009 lows, right? I mean, it's just straight parabolic. This is your .com bubble over here. But you can see even with the .com bubble, this stock went from like 53, and this was the biggest company at the time during the .com bubble. Goes from 53 down to about a year plus later down to 18. So big sell-off there. I'm not sure that we're going to get anything like that, but you can see the extent of this bubble and how much more of a bubble burst that could play out here to where, yeah, maybe we do see a move back down to 150. If it moves back down to 150, we're still at 2020 pricing. That's only like 2-year-old pricing right there. So keep that in mind. Keep that in mind that these sell-offs that we're seeing may just be the beginning. And so for me personally, I'm treating a lot of these moves that we're seeing back to the upside, like yesterday's rally and the Russell 2000 trying to rally back today into green for a little bit. I'm looking at those as dead cat bounces. Eventually, I'm going to short those rallies if they continue. CVX, let's take a look at it here. All right, Robert asking about CVX. I love the dividend on this one, man. Incredible dividend, breaking through some major resistance here. Back, look at this thing. It's crazy, man. It is just right there. It's not new all-time highs, because I mean, if you go back to 2018, still not above that price level yet. See how high has it gotten? I think you had some from 2013, 2014. Yeah, so I mean, long term, look at that level there. It's getting right up against some major resistance there. So I mean, maybe we're in this big price expansion getting ready to happen on CVX. Really like the chart. But let's go ahead and get rid of that big line and look at it from the more short-term time frame going back to 2018. Big breakout. You saw heavy dip buying follow through today. So I think at this point, from a long-term standpoint, all is good. I think if it gets back down below this, 110 level, that would probably be bad for the stock there. It also would be back below this breakout level as well. From a trading standpoint, I'm looking at booking profits along the way. So I'm taking a little bit off the table there. If you're in it for the dividend, yes, you're getting a lot of growth, plus you're getting the dividend. So maybe that's a different play. But from a swing trading standpoint, 20-day moving average looks like it has a little bit of support there as well. So doesn't hurt in this market to be aggressive with the profit taking. But I mean, overall, CVX, you couldn't ask for a better chart in this kind of market. We got Kevin saying hello from Lakeland, Florida. PayPal. Hearing a lot of people trying to start jumping back into this PayPal. I traded it. You can see it didn't work out for me. I was playing this base here, started to break out and fell completely apart. I went ahead and got out at around, I think it was like 187, 188, but took a small loss on it, about 4%. But it's a good thing that I did, manage the risk on it, because look where it's trading at now, 158. That saved me about $30 of downside. I think this gap, and this is the one that he's talking about here, going back to May of 2020, is very, very good possibility that we see this gap get filled here. And most gaps do get filled over time. And that would be a lot more downside, another $13 or $30 to the downside. You're looking, at almost 20% more of losses for the holders of PayPal. You also have a lot of support right there at that gap level. So actually, let me rephrase that. If you take the support level right here, you could see it bounce before it gets to the, no, let's see. Yeah, this little support level here is right there in the middle of the gap. So it could get back down to like 135 and find support and bounce as well. But that's really the next major support level before it tries to fill this gap. So interesting chart, though. I don't think it's worth getting into right now, or at least from my angle, it doesn't. Audrey reminds me that the PE ratio of Microsoft back in 2000 was 76. Very true, and it's not anything near that. But I'm not trying to say that we're going to see a sell-off to the magnitude of 2000. What I'm trying to show you is that stocks during extreme market conditions can sell off far more than we ever imagined. Nobody would have said that Microsoft was going to go from $50 per share all the way down to 17. And likewise, don't ever estimate how far a stock can drop, because when it happens, you want to make sure that you have those stop losses in place. That's why I preach this risk management so much. So in any case, that's going to do it for today. A couple more charts that I wanted to throw at you is 2108, T2108. This is the percentage of stocks trading above their 40-day moving average. And you can see we got about 23% of stocks doing that right now. The extreme readings that I'm looking for is to get back down to around like 3 and 4%. That's where your best opportunities for creating long-term positions in the stock market arises from. Again, the T2107, this is the percentage of stocks trading above their 200-day moving average. You still have about 27% of stocks that haven't broken it just yet. So keep that in mind here. Even though it's been fading since December, you want to realize we're not at major extremes in this market just yet. Make sure to hit the like button. Make sure to subscribe. Check out the join button down below. You'll get all my market research. I'm still coming off a little bit of the COVID right now. So, I'm going to continue to try to keep doing the videos and do another live stream on Thursday. But, if you guys have any questions, put them in the comments. I'll be glad to answer them. Thank you guys, and God bless.